You know, every so often, a financial forecast comes along that just makes everyone stop and pay attention. Well, one of those just dropped, and it's all about one of the oldest assets on the planet, gold. So, could the price of gold really be on a path to $5,000 an ounce? Okay, let's break this down and see what's actually behind this pretty wild headline.
And there's the number, $5,000. That is the potential price target per ounce that Goldman Sachs is floating. Now, to give you some perspective, that's more than double where it was just a few years back. This isn't just a small price bump we're talking about. It's a monumental leap. So, the big question is, how on earth do we get there?
Now, before you write this off as just some crazy guess, you have to look at where it's coming from. This isn't some random blog post. This is Goldman Sachs, a massive player in the world of finance. Their analyst, Samantha Dart, is on record calling gold their highest conviction long recommendation. And trust me, when a firm like that uses language that strong, the market definitely sits up and listens. So what could possibly light the fuse for a rally this big? Well, according to the analysts, the main catalyst isn't what you might think. It's not a new gold mine discovery or anything like that. Nope. It's a political threat to one of the most powerful financial bodies in the world, the U.S. Federal Reserve. Okay, so at the absolute heart of this prediction is this idea of Federal Reserve independence. The easiest way to think about the Fed is as a neutral referee for the economy. Its whole job is to keep things stable, managing inflation, keeping employment steady, by making decisions on interest rates without getting pushed around by politicians who are just thinking about the next election. This independence is pretty much seen as the bedrock of a stable economy. And this right here is the trigger. Analysts are looking at specific political moves, like the Trump administration's effort to remove a sitting Fed governor and put in someone who favored cutting rates. The big worry is that if people start to believe the referee is no longer neutral, well, the entire game starts to look a whole lot different. So how does one political concern turn into a $5,000 price target? The theory is that it could kick off a chain reaction, kind of like a series of financial dominoes, one tipping over the next and sending ripples through the whole global system.
So the sequence would probably look something like this. First, you get the threat to the Fed's independence. That's domino number one. If investors start to think politicians are forcing the Fed to keep interest rates artificially low, they're going to start worrying about inflation taking off. That's domino number two. Higher inflation, of course, eats away at the value of money, which leads to domino number three, a weaker US dollar. And when investors around the world lose faith in the dollar, where do they run for safety? For centuries, they've run to gold. That's the final domino.
Okay, that domino effect makes logical sense, right? But it still feels like a massive jump to get all the way to $5,000. Well, the analysts at Goldman actually drilled down on how it could happen, and it comes down to a really small number, just 1%. This is the key what-if question that the whole analysis hinges on. Right now, U.S. Treasury bonds are seen as one of the safest places to park your money on the entire planet. But what if those fears about inflation and a shaky dollar cause investors to move just a tiny, tiny fraction, just 1% of their money out of that huge market and into gold instead? What happens then? And there's your answer. That little 1% shift in capital would be enough to trigger what the analysts are calling an explosive gain, pushing the price of gold right up to that $5,000 mark. The really crucial thing to get here is that it wouldn't take a full-blown financial panic, just a relatively small shift in where the money is flowing to create a huge outcome. This whole thing brings us to a bigger question, though. Why gold? I mean, we live in a world with stocks, crypto, all sorts of assets. So why does this ancient metal still have so much sway when things get uncertain? Well, for starters, just look at how it's been performing lately. In the year leading up to this forecast, gold shot up 38%. It didn't just outperform the stock market, it blew past Bitcoin, which a lot of people were calling the new digital gold. Performance like that really reinforces its classic reputation as the go-to safe haven asset. And it's not just politics. There are a bunch of other strong forces, or tailwinds as they call them, pushing gold's price higher. You have central banks around the world buying up tons of gold to move away from relying so much on the dollar. At the very same time, you have regular investors who think the Fed will have to cut rates soon, and they're pouring money into gold ETFs. It's really kind of a perfect storm of demand. So, is Goldman Sachs just out on a limb all by themselves here? Not at all. Actually, when you zoom out and look at the bigger picture, you see that this really bullish view on gold is part of a much wider feeling across the whole financial industry.
For example, look at JP Morgan, another financial giant. They have their own forecast, and they see gold hitting over $4,000 by 2026. So while the exact numbers and the timelines are a little different, the general direction is exactly the same, way up. It shows there's a real growing consensus among the top minds in finance.
And finally, all of this is happening against a backdrop of some serious global supply risks. Think about it. So many key commodities, from energy coming out of the Middle East and Russia to the rare earth minerals from China that power all our tech, are being caught up in geopolitics. Analysts are pointing out that this growing risk of supply shocks makes an independent asset like gold, something no one country controls, look even more attractive.
So all of this leaves us with a really fascinating question to think about. On the one hand, a forecast like this points to what could be a huge investment opportunity. But on the other hand, the very reasons for it, political chaos, fears of inflation, a weaker dollar, are basically a giant warning sign of some deep economic instability ahead. So which is it? Is it an opportunity or is it a warning? I guess the answer really depends on where you're standing when those dominoes start to fall.